Hey Ben,
Hey.
how's it going? Okay, sounds good.
All
Here,
right.
I'm gonna
That's
go ahead
better.
and
Can
I'm
begin.
gonna turn you around so you could get a sense of the room real quick. Everyone, go ahead and say hi to Ben Leybovich.
Hi, Ben.
Hello, guys.
All
How are
right,
you?
we got some young members in here too.
Oh, yeah, I
Excited to
know. That's
hear.
exciting. I see
Yeah,
some youngsters.
you get to educate the voices of the youth as well. All right. Well, I just want to do a real quick.
They'll dig the calculus.
I'm going to do a real quick introduction, Ben. Just for those of you, if there's anyone who actually hasn't heard of Ben Leybovich. Exactly. I'm making a phone call. Uh, all right. All right, everyone. It's with great pleasure that I want to introduce today's guest speaker. His name is Ben Leybovich. If you're a fan of Bigger Pockets, and if you aren't, you should be. This man needs no introduction. I got to know Ben about 2 years ago when I was first starting my foray into real estate investing. I came across one of his articles. I think it was very diplomatically put as why you shouldn't buy $30,000 pigs. And I remember reading that article and thinking, wow, I like where Ben's coming from. He's got great perspective. He thinks about things from a number standpoint. And at the same time, his analysis always left me thinking that I had learned something from his article. So I was really excited to finally be able to reach out and connect with them. Over the years, we got to know each other better. I'm proud to call Ben one of my friends. And so we're just really happy to have him here today at the Seoul Real Estate Investing Meetup. So let's give him all a big round of applause. Hey Ben, welcome to Korea. It is Saturday, so we're actually in your future. Ask us anything you want to know. Can you hear us?
Thank you for the good welcome. I
Yeah.
have no idea what I'm doing here. It's like, 12:30 in the morning in Ohio. Is somebody paying me for this or what? I mean, I like you, Dan. I like Bigger Pockets. I love Brandon because, he's my girlfriend. But damn, it's 12:30 in the morning over here. Wow.
Way to warm up
I
a
got
room, Ben. Way to
myself-
warm up a room. Well, Ben, I know you've been on countless interviews, and you probably have said this story already before. But just if you don't mind, would you just go over a little bit about how you first got started in investing in real estate?
Let's do this part really fast
All
because
right, go
I
ahead.
want to get to the stuff where you guys can ask questions and can learn something.
Yeah.
Because my story, probably everybody knows my story by now. Multiple sclerosis. Multiple sclerosis was a diagnosis I received in college. I'm a violin player by trade. I received this diagnosis. I was quite depressed for a number of months, probably closer to a year. Finally got out of depression. Started looking for answers. Doctors are telling me, they don't know how long I have before I lose mobility. At the same time, they're telling me don't do something stupid. So it was a confusing time, but things came into focus eventually, and it became very clear that I have to be generating income passively in one way or another because that's the nature of the beast. I'm holding up. I'm knocking on wood here, knocking on wood right now. I'm holding up pretty good in terms of my health, but the thinking still remains.
Yeah.
For me, it was a very vivid thing. It wasn't about money, and it wasn't about, I don't want to have a job anymore because I'm too good for it. And, it wasn't about, I don't like my boss. Although I never liked my boss because I never had one there. But it was a much more serious problem. I really didn't know what to do with myself. So investing wise, if you're going to have passive income, you only have so many avenues to pursue. And then when you compound not having, or rather needing passive income, but not having any seed capital from which to start, then, what do you got? Yeah, real estate is one of the few things because of how real estate works. If you have the knowledge, you don't so much need the money necessarily, at least not to get your foot in the door, to get something going out of nothing.
Was that something? Yeah, go ahead. Sorry.
No, I'm done.
All right. Was that something that you mentioned real estate and having that obviously a very strong motivation to find passive income? Is that something that you ended up jumping into right away? Were you one of those stories?
No. I studied for many years. My first ding, 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 ding in my head happened when I was still in college. I was a violin player. I was practicing real hard in the practice room all the time. And I think my MS diagnosis came in the second year of my master's program at Cincinnati. However, when I was a first-year master's student at Cincinnati, a kid came in who was an undergrad student. Well, interestingly enough, he came in and his father bought him a house across the street from the university. And they put locks on all the doors, and he became a landlord. And to me, for a long time, it made no sense at all why somebody would, we classical musicians, we're privileged. We just have an attitude that we're better than everybody else. That's just the way it is, So I was no different. I was pretty good at classical music. I was a pretty good fiddle player. And so I thought I walked on frickin' water, okay?
Yeah.
Josh Dorkin still says I walk on frickin' water. Don't listen to Josh Dorkin. He doesn't know what he's talking about. I've learned since then that I don't. But back in the day, why would you take care of leaky faucets, leaky toilets? Why would you be a landlord? Why would you put yourself through that? You're a musician. Go practice. Clean living, very blue collar. I didn't get it until I got it. Eventually, I got it. He was living for free. His father bought him a house across the street. When he finished his undergrad, he sold the house. I don't know, probably sold it for more. That's before 2007, 2008 crash. Probably sold it for more than what they paid for it. The kid lived for free the entire time he was in college. Yeah. So that was kind of my first experience with what real estate could do. And then a mess happened. I started thinking and things were compounding, and that just kind of synthesized into, okay, I got to figure out this thing about real estate because it's probably my best shot at getting something done.
Right. So. Well, one thing that over the years, you definitely have shared a tremendous amount of valuable information on BiggerPockets and also on your website.
No.
Just has been
me?
Yeah. You've written a few articles. You've written an article or two, I believe. And one thing that's always interested me, because it's something it's hard to get information on, is this idea of capital expenditures. And could you? And I found one of your articles on capital expenditures. I thought that was one of the best articles I've read to really understand the numbers behind investing. Could you just go over a little bit about CapEx and what it is and sort of how it could affect someone's investing returns?
So, when we say the words CapEx, capital expense, we mean one of two things. When you buy a property and it has deferred maintenance, what you are doing is deploying capital in order to rectify the deferred maintenance. That's upfront capital expenditure. The money that you're spending, you might as well consider that money part of the seed capital, because this, if it needs a new roof or it needs a new boiler or it needs those things right away. And the reason you're getting a deal on the thing is because you're going to be willing to take over this project even though it's not in perfect operating condition. So that's one piece of it. That's kind of easy to understand, wrap your head around. The difficult part about CapEx is something that is a CapEx withholding or a CapEx recapitalization. It's the notion that what we're dealing with here is physical components. I'll take a step back.
Yeah.
The internal IRS gives us a tax break. Most people see it as a tax break. It's called what is it called? Depreciation.
Depreciation, yeah.
And when investors talk about depreciation as some kind of magical thing, some great thing that exists that investors get, what's going on is the IRS is saying this: look, dude, you bought this property.
Right.
We are aware that this property is going to keep getting older. The components in it are going to keep getting older. Just like a light bulb eventually burns out and you have to replace it. Yeah. Same is true of wiring, plumbing, roof, even foundation, siding, windows, doors. All of this stuff gets older. So over time, you have to replace it. Right. So we're going to give you depreciation right now. It's a tax shelter. You can take these savings that we're giving you on taxes and you can set them aside so that you are prepared to deploy them later on in order to rectify deferred maintenance. Basically, we're talking about CapEx. So if you take a property apart piece by piece, okay, and you allocate a lifespan to each of the components, like the roof, how long does it last? Well, anybody that's put a brand new dimensional shingle roof on that's got a 25-year warranty on it, you know that if you let it sit there for 25 years, it's probably too long. It's really not going to last for 25 years. A 25-year or a 30-year rated roof is going to be good for 20 or 25 years, depending on the climate. In the Midwest, faster, whatever.
Right.
So, but the point is that, okay, you say to yourself, replacement of this roof is going to cost me $5,000.
Right.
I'm buying this building. I've done my inspections. I think this particular roof that's on this building has 12 to 14 years of life left on it before its useful life is expired and I have to replace it. Well, what that says to you is that now you have to take that number, $5,000, you have to divide it out by the number of years and the number of months that you have remaining in the lifespan of the existing roof, to recapitalize yourself so that you're prepared to deploy this capital. Okay?
Right.
So you either hold it out of the cash flow today, or it's going to hit you like a ton of bricks 12 years down the road if you still own the property.
Right. So you're basically setting aside some money.
You're basically setting aside. You're recapitalizing yourself. Okay? So if you go through all of the major components, and that was the big coup we wrote, Serge and I wrote an article on Bigger Pockets where we just kind of very simply went through, here's a roof, here's the lifespan, here's how much you have to hold back, presuming you are starting with a brand spanking new roof. Same is true for the, electrical, appliances, windows, doors, flooring, the flower beds, everything. You go through and you say, okay, this is how long it's going to last. Let's pretend we're starting with a brand new piece of equipment in each case.
Yeah.
How much do you have to hold back?
Right.
Now, you have to amplify that or synthesize it with the fact that when you're buying something, you are not likely going to have brand new everything. So if you're buying a property that's being repositioned, for instance, does it have a brand new roof? Or maybe the roof is 10 years old. It's just good enough, so it hasn't been replaced.
Right.
So you have to kind of use your best judgment to look at the components and say, okay, well, this is how much I got to hold back. But, and it varies with asset class. It varies with location, because if you go out to Arizona, you've got very corrosive water. So the plumbing, life of plumbing in Phoenix, Arizona, for instance, is a whole lot shorter than it is in Ohio or Indiana or Kentucky, for instance.
Mm-hmm.
However, over here,
Right.
we have snow seasons.
Yeah.
But over there, they have terrible sun,
Right.
which heats the roofs. So their AC, you see, it's all a moving target.
Right.
So whatever market you're interested in buying, you have to understand the specifics of that market,
right.
geographically speaking,
Right.
and understand the lifespan of all of the components so that you can take your cash flow and suck this amount of money that you think is going to be sufficient out of your cash flow.
Right.
And of course, you figure your return on investment
Yeah.
after the fact.
Right. Because even though the money's in your bank account, it's not really. Sooner or later, it's
Right, it's not yours. It's not yours. You can try to time the sale of the asset to find a fool who doesn't know better.
Right.
You can try to do that, and that's probably what a lot of us want to do, you know, but what if you can't? Or
Right.
what if it's an asset worth holding
Right.
because it's appreciating in value or something like that?
And Ben, you actually have bought some of these some single family homes in the past.
Right.
And what were your experiences? Because I know that you speak a lot from just your own personal experiences, and that's one of the things I was impressed about when I read your articles is that you weren't telling people to do something that you've never done, but that you had actually done before.
Right. Well, I still have some of them in my portfolio. All they're doing is breaking even at best.
Mm.
I mean, you know, today I got a call that one of my SFRs, it's a pig.
Right.
Okay? It is a pig. It rents for $600. I bought it for $20,000.
Right.
And I put $20,000 into it.
Right.
Your typical Midwest pig.
Right.
That's what it is.
Right.
I got a call on it today.
Yeah.
That a tree that I trimmed 3 years ago, a big old tree in the backyard, now has to come out because the root structure is so bad that it's bringing up my driveway, and you know the tree's causing all kinds of havoc. And I just trimmed it like this. There was hardly anything left 3 summers ago, and it's already like all like that, and so that's $600.
Wow.
Well, you know, I mean, how do you make money with crap like that?
Right.
No, you don't. You buy stuff like that before you know what's going on, and then you don't buy stuff like that anymore.
Right. And I think one of the, you know, in some of your articles, something that's very relevant to a lot of our investors, because we are overseas and we don't really have, if we want to invest in America, we don't have a lot of options in terms of property management. So obviously the turnkey model, the TK model, is something that a lot of us have looked at some point in our investing careers. And I know that's something that you've written articles about. You've been somewhat critical of the turnkey model, and I was just wondering if you could talk a little bit more about where that's coming from.
Okay. Somewhat critical kind of doesn't really do that justice, if you've read any of my articles. Right. Okay, so let me see if I can figure out this screen share, because I knew you were going to ask me this.
Okay.
Because I know you guys are in Korea, so you got to ask me about TK. I mean,
Right.
So I prepared a little spreadsheet.
Thanks, man.
Hopefully you let me know when you can see my screen.
All right, it's
a picture of you.
It's coming. We got the. All right, there we go. All right. Let's see if
All
I
right.
can enlarge things.
Okay. I thought I'd personify this conversation a little bit. This is a lot like what a lot of you are going to see in a TK pro forma. Okay? We're talking about an SFR. You're being offered this SFR for $45,000. Does everybody see my little spreadsheet?
Yeah.
Okay. You're being offered the SFR for $45,000. It's going to rent for $850 a month. Okay? The operating costs on it are $120 property tax a month, $60 for fire insurance. It's a single family house, so you're being told you pay no utilities. Repair and maintenance, 10%, pretty standard. Vacancy, 10%, pretty standard. Management, 10%, pretty standard. So you get total expenses of $435. And of course, rectified against the gross potential income of $850, that will give you net operating annual of $49.80. Okay?
Yeah.
Okay. Now, you take that a step further. At a gross rent multiplier, that would seem to give you a value of $68,000.
Right.
At a 12 cap, that would give you a value of $41.5.
Right.
Your actual cash-on-cash return in this case seems to be about 11%.
Yeah.
Okay?
Yeah.
Let's take that a step further.
Real quick, before you move on, just a gross rent multiplier is just one way of trying to find out what something's worth, and you just multiply the rent by a certain multiplier that's standard in that area, and that's how you...
Correct. So it's the multiplier is different. You got to talk to an appraiser.
Right.
It is very ineffective at truly valuing property because it takes into consideration the gross income, but it doesn't take any of the expenses into consideration. And you could have two identical houses, one of them with gross income exactly the same. But one of them has taxes of $100 and the other one has property taxes of $200.
Right.
So obviously the expenses are going to be different by $100.
Yeah.
And if you are figuring your valuation based on nothing but the income, then you completely miss that point.
Right.
And the more units you have in the building, the harder it becomes to value with the gross rent multiplier method.
Right.
So this just shows you, we as investors think in terms of capitalization rate, which is, they're very similar in nature, but the GRM uses a multiplier based on the gross income, while the capitalization method uses also a multiplier, which in this case is a capitalization rate, but it's based on net operating income. So it's comparing apples to apples a lot more. And this example illustrates the problem. Like in Lima, Ohio, for instance, 78, 75 GRM is what you are going to find. So GRM of 80 is pretty close. I may be a little bit high on that, but you're over $20,000 apart in value going from the gross rent multiplier method to the capitalization rate method. And those are all loaded subjects, and that's not the point for this conversation. The point is, it appears that you have 11% cash-on-cash return based on net operating income, and this is a function of cash purchase property. You don't have a mortgage in this anyway at this point.
Right. It's all cash.
Okay?
Yeah.
So you've paid $45,000 all cash for this house. And a lot of TK guys will tell you that that's the right thing to do because it's safer.
Right.
Because you don't want to have that leverage, because you don't want to have a mortgage payment. Why? Because you're talking about a spread of $850 minus basically $450, which is $400.
Right.
Your mortgage payment on $40,000 is going to run $240 a month at 6% amortized in 30 years. I can do this shit in my head.
Right.
You take 400 and you take $240 out of that. How much cash flow do you have? Right? It doesn't look so sexy. So they tell you, nah, it's not safe.
Yeah.
Okay. Let's leave that alone for now. Let's go on. This is your IRR calculation. Internal rate of return. So this is what you spent out of the gate, $45,000 to buy the house. Let's assume it's in perfect condition and you don't have to spend any money going in. So cash flow year one this is basically your cash flow, which is this number right there, the NOI. That's your cash flow.
Right.
But juxtaposed against having spent $45,000 to buy the house, basically you are net negative $40,020 in the first year. This is just the way IRR works, right?
Right.
Then in year 2 you have this cash flow. Year 3 you have the cash flow as if. Year 4 you have the same cash flow.
Right.
And then year 5, what I'm saying in this formula is that you have this same cash flow, 4980. Plus, you sell the house for exactly the same thing you bought it for, which is what a lot of TK guys will tell you. Don't worry about appreciation. This is a cash flow property. You're buying for cash flow. You don't need to worry about appreciation.
Right.
And then subtract 6% or whatever it is for management fees. And this is what you get. And you get an IRR of 13%. Looks great.
Right.
There is a few issues here. And, numbers are all about telling stories. So let me see if I can put this story together for you, okay?
Yeah.
First, we don't have any utilities here, but we have vacancy. Guess what? If you have vacancy, you're going to have utilities because you have to power the house.
Right.
Especially if this vacancy is in the winter. You have to heat the house. So I can't tell you how much utility you're going to have, but let's just keep it simple and say that on the average you'll spend at least $600 a year, which is $50 a month. Doesn't seem like an unreasonable number, since we're on a monthly basis here. I'm just going to put $50 a month. Because if you're going to have a 10% vacancy, that's almost $1,000. 85 times 12 is almost $1,000. That's a month and a half. So if you're going to have a vacant house for a month and a half, you're going to have some expenses and utilities. Just simple as that is, right? So we put that in. You're probably this is one of those perspective things where you read the numbers and put the story together. Then we get to the terms. Well, guess what? If you're going to have vacancy, you're going to have to clean up after the tenant in order to prepare the house for the next tenant. How much do you think? You guys tell me, how much do you think it'll cost if you only have to turn the house one time per year? Can you do it with $200? Can you do it with $400? I mean, to clean the floors is going to run you, I don't know, in a 3-bedroom house with carpet, that's probably going to cost you $130, $140, $150 just to clean the floors. You got to at least wipe down the walls. You got to pay somebody to come in there and make sure, nobody leaves the house perfect. So, well, let's just pick a number. Dan, you pick a number. This is monthly basis, so you pick a number.
A monthly basis. Let's see. Why don't we pick? Anybody have a number you want to throw out? Anyone? Has anyone?
At least $100.
At least 100. How about $30 a month?
Okay, $30 a month.
That's low.
Is that
Now,
low? Is that too low? Oh, we're hearing low. Okay, let's go higher.
well,
The price
I'm not
is
going
right,
to put
but-
words in your mouth, but I think you're nuts if you think you're going to get away with $30 a month, personally.
All right,
But
okay.
whatever, I don't care.
100.
It's
Let's
not
go,
my
let's go.
pig.
We're going 100.
I know
We're going
what
100.
my
We're
pigs
going
cost.
100.
100. 100.
$100 a month?
Yeah.
Okay.
Yeah. There you go.
Now we have a little thing called economic loss right here. This is a thing about storytelling, guys. If you have a vacant house, there's a story behind why it's vacant. Tell me, why do houses go vacant?
Lack of desirability.
Okay,
Or
lack of
glut
desirability.
in- what's that? Cheaper options, glut in supply. Is that what you're saying? Yeah. Not enough demand.
Well, could it also be because somebody didn't pay you and you evicted them? Could it be
Failure to
because
pay.
somebody left in the middle of the night and forgot to tell you?
Yes.
Could it be because you had to pay an attorney and you had to pay court fees and you had to, you had to pay the sheriff to come out and kick him out because you can't do it yourself legally? Because it's outside your LLC, so you can't represent yourself. You have to have an attorney represent your LLC.
Right.
Do you see where I'm going with this?
Yes.
So anytime you have physical vacancy, there are other costs that are brought on by physical vacancy, such as bad debt, such as loss to lease, such as concessions. If this happens to you and you are antsy as hell to get the house filled, won't you go give somebody 2 weeks free rent just to get somebody in the house?
Yeah.
Won't you discount your rent?
Right.
What are the chances of you doing that? Now, all of this costs money. All of this backs into real dollars. Do you understand?
Right.
So, typically when I underwrite a building, if I underwrite a 100-unit building, 150, 250-unit building, you will very seldom see my underwriting have anything less than about at least 6% economic loss.
Okay.
At least, which will include all of those numbers like LTL and bad debt, and concessions, all of that stuff.
Yeah.
Okay?
Yeah.
So if you think you can do better, great. So let's just go ahead and put 3% in here and be done.
Okay.
Okay? Personally, $25 a month, that'll give you $300.
Yeah.
I don't think you can get an attorney to do an eviction for $300
Yeah.
in America.
Right.
And then you have court fees.
Right.
And then you have lost revenue because you evicted somebody and the house was trashed, and so you had to fix it up.
Right.
And it took you a month.
Right.
Because you're not there.
Right.
You're counting on somebody else to stay on top of this stuff for you.
Right.
So 3% is kind of a joke.
Okay.
All of these costs get bigger as the property gets smaller, which is what makes SFR probably one of the least attractive investments, unless you are buying it with a ton of equity, and unless you are buying it at considerably over $1,000 of rent, instead of $800, $850.
Right.
But let's just leave that 3%. Then you have this CapEx number.
Yeah.
And this is basically you're asking yourself, for when stuff breaks, like a water heater or a furnace or, whatever, how much money do I need to be holding back, in order to deploy? And Serge and I did that article.
Yeah.
And we came up with a figure of like $260 a month.
Right.
On an SFR, a little bit less than that. And I'm sure we missed a bunch of stuff.
Yeah.
And, there was a firestorm on Bigger Pockets, arguments, and everything else. But anybody reasonable would probably say, you got to hold something back.
Right.
Stuff's getting older, so you got to hold something back. So what do you guys want to do? You want to do like $200 a month?
Okay.
You want to do $100 a month? I mean, you got, this is where the problem is.
Yeah.
I mean, you guys are sitting there, and to you, it sounds like a matter of choice. To me, 10 years in the trenches, I know stuff breaks, and I know what I spend money on. This year, a great sixplex that's supposed to be working great, I had deployed so much money because I had, bay windows that were the size of Suez Canal. I have 6 of them in this damn building. All the rest of the windows have been replaced with nice double pane vinyl windows.
Yeah.
But the big ones are so expensive.
Yeah.
they are $1,000 plus per
Wow.
window to replace. But
Wow.
guess what?
Yeah.
They rot. And you know, a couple of them got to a place where I had to replace them. But do you know what it does to a little sixplex that's supposed to be cash flowing $6,000 or $7,000 a year when you have to go out and spend $3,000 just like that,
Right.
just to keep the building functioning?
Yeah.
I'm not putting gold-plated toilets in these units. I am just replacing parts that have outlived their useful life.
Right.
They have to replace. That's just all it is.
Yeah. Yeah,
Okay.
Ben and I are actually, we're going through a little bit of a issue with one of our properties, and well, our only property. And yeah, we had to replace our windows, and it's costing us about $1,000.
So, I mean, it's not a matter of choice.
Mm-hmm.
You know, unless your TK guy goes through everything and replaces everything, which they can't do, because if they did that, the value of the replacements would be more than the value of the house that the marketplace can support.
Right.
So they can't do that.
Yeah.
But even with the numbers we have, look at this. You have $850 of rent and $710 of expenses.
Uh-huh.
If you really look at expenses very honestly, most people lose money in real estate, guys, I gotta tell you.
Right.
Very few people actually make money.
Mm-hmm.
So that changes the picture quite considerably. It gives you a cash and cash return of 3.72%. You'd be better off buying bonds.
Mm-hmm. Right.
Okay, and it gives you an IRR even less, 3.13%. Not even enough to recuperate inflation.
Right.
So that tells you what the story is. Now let's look for a solution to that story, okay?
Mm-hmm.
Let's just look for a solution. Let's change the purchase price from $45,000 to $20,000
Right.
and see what that does. And it does nothing much. Guess why? Because the purchase price
Right.
is only going to enter the equation when there's a mortgage involved.
Right.
And since you don't have any mortgage, you're not lowering any operating costs.
Mm-hmm.
I'm describing to you a pig.
Mm-hmm.
It doesn't matter if you buy it for $20,000 or $45,000.
Mm-hmm. Mm-hmm.
It's not going to save you. Now, what will save you is if you can do this. If you can do that in this house,
Right.
okay?
Yeah.
Then you're looking at this, IRR of almost 12%. Now, here's the interesting part. You're not going to be able to do that. Not in Midwest. But what you could do is you could go to a more desirable location.
Yeah.
You could buy yourself a house like that for $90,000
Right.
that would rent for $1,600 a month.
Right.
Okay?
Yeah.
And then you have this. But something interesting happens here. Because now you're not buying a pig. You are buying maybe a 20 or 30-year-old home
Yeah.
in a good location.
Right.
So what if when you are exiting it,
Mm-hmm.
you are not selling it for $90,000 that you paid for it? What if you are selling it for $130,000?
Mm-hmm.
So there's an additional $40,000 waterfall.
Yeah.
And now you've got yourself an investment.
Right.
So what happens is, it's not really, okay, so you don't have $90,000 to spend.
Right.
Fine, get a mortgage.
Mm-hmm.
Because look, your income is $1,600. Your operating costs are under $1,000.
Right.
If you finance $60,000 of this house, it would cost you, $400 a month.
Right.
You can afford that.
Right.
let's just do it for practice. Let's say your mortgage is going to cost you $400 a month. So there's your expenses,
Right.
and there's your income.
Yeah. Yeah.
So you can figure out the cash flow, right?
Yeah.
But look at this, still 12.8% IRR. That's real return. Why? Because of appreciation.
Right.
So your cash flow is not so hot, and your cash on cash return is not so hot.
Right.
But because of appreciation, you are driving your returns. Now, the actual truth lies somewhere in between, guys.
Right.
You can't buy something that looks like 3% cash on cash. It's too dangerous. There's
Right.
not enough cash flow to sustain economic shocks.
Right. Right.
But
yeah.
the narrative I'm telling you is that you need appreciation. So how does a guy like me make money?
Yeah.
A guy like me buys, a sixplex for $200,000
Yeah.
that is appraised 4 months later for $275,000.
Right.
That's called forced appreciation.
Right.
A guy like me buys a 10 unit for $375,000. It's appraised for $450,000, and I have a mortgage for $350,000 on it, so I've got $100,000 equity.
Yeah.
That's how I'm driving my return. A guy like me does it with no cash out of pocket because of creative financing.
Yeah.
That's how I drive. A guy like me drives my returns.
Right.
You can't, you can't do that. I understand you can't do that.
Right.
So, if you're asking me for what the solution is, unfortunately, I can't tell you, aside to tell you that you need to buy quality.
Right. Yeah. Yeah. Wow, Ben, that's awesome to have prepared this spreadsheet for us and to dive down as deep as you have. I know, wow, we're getting past 1 o'clock on your end. So, do you have time for a few questions, Ben, or?
Yeah, absolutely.
All right, let's. I want to open it up a little bit because I know some people are thinking about turnkeys and other types of investments. Does anyone have any questions they want to ask Ben at this point? I think everyone's still absorbed by those numbers. Yeah. Oh, do you want to do it now, Jacob?
Yep.
Yeah.
Wait a second.
Yeah, we got a question coming up, but we.
Sure.
Baby situation.
Hey.
Who's ask right now?
Hey Ben,
Hi.
this is Jacob Michaels. I actually do some wholesaling from Korea, focusing on Dallas, and I know that you here are focusing on turnkey properties and how they're kind of pigs at the lower end. I will say though, I kind of disagree in one sense. Turnkey, yes, but the lower end properties. 1 second. A lot of my buyers, I do a lot of those lower end properties. A lot of my buyers actually buy the properties from me, renovate it, and then sell it on a note. And that's really what they do at that lower end. It works really, really well.
Sure, and there's a difference here. They're not holding it.
Exactly.
So it is a pig, but they don't really see the effects of it being a pig because they're not holding on to it.
And they don't deal
So
with
I'm presuming that I'm speaking to a room of buy and hold investors. Those are the bellwether words. Buy and hold investors.
Sure,
Right.
All I'm saying is that when you are buying a low end property, and secondly, when all of the equity is taken off the table from you, because you obviously got to pay the TK guy. He found the deal, he rehab deal.
Yeah.
So, and the messaging is, well, this is a long-term hold, so you're buying it for cash flow. So yeah, you're not going to be able to turn around and sell it. All I'm saying is that that's not safe, because to me, safety of a real estate investment is a function of two things.
Right.
Being able to sell anytime you need to, and being able to hold if you want to.
Right.
So when you buy a cash flow property, you can hold it for a long time. That's fine. That's only half of it. You also need to be able to get out if you really need to. And if you're giving up all your equity, you can't get out.
Right.
By definition, you can't get out. And so I have an issue. I have an issue with that.
Right.
But I see what you are saying. I mean, your model works, but it only works because they're passing the problems.
Exactly.
They're putting the lipstick on the pig and then passing the pig to somebody else and let them deal with the eventuality of what they are.
And usually they're selling to owner-occupants. So these people are living in the property. If anything happens to it, they fix it up. It's their own house. There's no problem. They're happy. Investors happy. But it's a way to invest in these pigs and actually make good money from it with the rental type income without all the risk.
Perhaps.
Yeah.
Good
Well,
point.
I was
You
just
know.
saying, because when I originally read your post about this on Bigger Pockets, 'cause I remember Bigger Pockets too, I kind of disagree. I agree 100% with overall what you're saying about turnkey and just single families at the lower end. But I kind of disagree with what the impression I came away with from your article, which was no one should be investing in these pigs. And there's a lot of investors making a lot of money with these pigs, but with a different strategy.
Sure, I'm talking to hold investors. If you're going to buy something and hold on to it, it needs to be better quality. It just does.
Yeah.
You get what you pay for. Now, yes, if you're selling to owner-occupants, there's a market in that. Not everybody can afford a $350,000 home. Most of America cannot. So those types of investors that are buying these things and rehabbing them and selling them, they're fulfilling a function in the marketplace. I don't have an issue with that. If somebody wants to buy it from them and do the inspection and everybody agrees and everybody knows what's going on, whatever.
Great. All right. Good question. Very good question. Yeah, over here. Jody has a question.
Yeah. Can you see me there? Or- Hi. I don't know if you need to see me.
Okay.
I don't know where to look, actually.
All right.
Here we go.
Yeah.
Okay. Hi there. Thanks very
Hi.
much. Hi. It was very, very informative, and I'm actually looking at buying a second property right now. So I just finished paying off my home, my apartment here in Seoul, and I'm looking at maybe using some of that to leverage to buy a second apartment and seeing how you were
Just real quick, Ben, can you hear her right now, or?
Yeah, I can. It's a little tough, but I
Okay.
can.
All right. Yeah.
Should I move up?
Yeah. Come over here. Yeah.
I feel a little bit shy.
Come on, Jody. Come on.
So
Step on down.
I don't even know if my question's even that good of a question.
Only the unasked question is the right question.
So actually, they do something here in Korea called ChongsA, and I guess I got something quite clear from you is that you have to think about location, 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 and that the equity is really the kind of key thing that we should be considering. And the current situation, if I could just, I don't know if I can get your advice almost, if you're okay, is that there's an apartment that's, say, $285,000, and $205,000 of that is ChongsA. So that means that I don't have to borrow any of, sorry, it's a little bit hard for me to concentrate. 205,000 is another person has put in this house. It's like rent. And so that money goes from owner to owner. So I have to pay the difference of 80,000 plus real estate fees, plus interest or land transfer fees, plus 10,000. So it's 90,000 of my personal money that I would have to put in. Now my question to you is, someone has said to me, well, that $205,000, that is the other person's money, the ChongsA money, is really your debt. And I'm just kind of curious, maybe I don't know if it's something you can even answer because it's a Korean-style system. Do you think that I should be looking, because basically I'm buying an apartment with all leveraging. Is that too much?
Ben, just to give you a little background, ChongsA is a system in Korea, very specific to Korea, where a tenant, instead of paying a monthly rent, puts down a huge deposit. In this case, they're putting down $205,000 on a $285,000 property, and that deposit that they put down is almost like a secured loan to someone else if you choose to buy that property. You could then apply that money that they put into the property as part toward the purchase of the property.
It is. It's
Yeah.
going from owner to owner.
Sure.
Yeah, so it's a very it's yeah
Well-
it's like getting a 0% loan from a private citizen.
Sure, but okay, so a debt in my mind has to be repaid, right?
Yes.
Absolutely.
Okay, so
Yeah.
the reason we use debt is to make money. So if you're asking me, should I use 100% leverage to get into this apartment? Can you tell me why you are doing it?
Because
How you are going to be making money?
well, just as what you had said, it's the equity. I believe the apartment value is going to be going up. It went up about 50,000 in the last 2 years, and I believe it's going to go up further. So,
Okay.
but who knows?
Does 285 represent a discount at the price
That's
currently
exactly
or
it.
not?
So
Market value.
So
Oh,
let
that's
me
market value,
A
okay.
little bit lower.
Yeah,
here's what you need to understand. I'm not a gambler. I do not buy for organic appreciation, ever. I have known so many guys get hurt who bought property just solely on the expectation that it's going to go up. Appreciation comes in two forms, either organic or forced. Forced appreciation is whereby you can do something yourself to improve the value of the property literally within 2 or 3 months, maybe 6. Maybe if it's a very large property, the repositioning process will take 2 or 3 years. But it's something that you can do as part of your strategy. Now, if you are buying a building like that with attributes of value add in a location that also exhibits natural growth, then you are simply doubly benefiting.
Right.
But unless you are I suppose there are markets. There are landlocked markets like yours where there's very little land and the real estate is very expensive because of that, and development is very difficult and very expensive. There are logical reasons for why things go up, in price, not value, but price. But I am of a mind, I organically just can't stomach the idea of not being able to control my own investment and buying strictly in an expectation that the market will take care of me.
Right.
Because sometimes it does and sometimes it doesn't.
Right. Right.
So whenever I buy something, I have 3 exit strategies.
Yeah.
So one exit strategy you mentioned is that the market has appreciated by 50,000 in 2 years and you think it's going to continue.
Right.
That's very nice for you because, of course, you are an expert real estate investor, and if you think it's going to continue appreciating,
Right.
then of course naturally it'll continue appreciating, right?
Right.
But maybe the Federal Reserve in America changes policy, and maybe that'll impact South Korea,
Right.
in a bad way. There are lots of things that could happen, right? I'm being a little facetious here.
Right.
But give me 2 more exit strategies.
Right.
Give me 2 more ways you are going to make money.
Right.
Above and beyond, the market is going to continue to appreciate.
Yeah.
What else you got?
Right.
Because if you don't have anything else, it's Russian roulette.
Yeah.
I'm not going to tell you not to do it because maybe you'll make a lot of money.
Yeah.
But I'm not going to tell you to do it because
Right.
maybe you'll lose a lot of money, and I don't want it to be on me.
Right.
Make
Yeah.
sense?
Yeah. Totally. That's Jody. Is that great?
Very much
I'm gonna go ahead and forward. You wrote a great article on the Symphony 10-unit building, which I think is a great exercise for people to really understand creative financing and buying, enforcing appreciation. So I'll go ahead and forward that to all our members too.
Sure.
Well, Ben,
But
yeah, go ahead.
it goes back to this concept. When we looked at these numbers at this spreadsheet, we looked at this and we said, okay, here's the cap rate, the 12% cap rate. Based on the cap rate, here's the value. What it takes is this NOI, which is this NOI, annual NOI, and it capitalizes a value based on that.
Right.
So if you're doing a value add in an income property,
Yeah.
what you are doing is driving your NOI. The higher you can get your NOI, the higher your valuation is going to come out based on the cap rate. Now, as you get more and more and more experienced at this stuff, you realize that even the cap rate is a bunch of baloney. We use it, but we don't really use it to value property. We use it to price out our exit.
Right.
But just understand this.
Right.
This is very, very important.
Right.
First, make sure you don't lose.
Right.
Then worry about making money.
Right. Right.
If somebody comes to you with a proposition that you're going to make a lot of money,
Right.
the first question in your mind should be, how am I not going to lose? With all the things that we know can go wrong in the real estate market, what is my strategy to not lose? That's the first thing you got to answer.
Right.
Then you worry about making money.
Right.
And the function of not losing, the safety in real estate,
Yeah.
is, as I said, the function of two things. One is cash flow, because income in excess of your expenses, true expenses. That includes this magical CapEx number. It includes all of the economic loss numbers. It includes true costs of management of tenants, with all the turns and all the bad debts and all the everything. If your income is truly greater than all of your expenses, then you can at least hold long enough to hold through the bad cycles in the marketplace,
Right.
to come out the back end and sell when it's advantageous to sell.
Right.
That's one piece of safety.
Right.
The second piece of safety is that a lot of stuff happens in life.
Mm-hmm.
And if you need to get out
Mhm.
now, can you get out now?
Right.
If you can't, you have a problem on your hands.
Right.
I have things in my portfolio, these stupid SFRs that I bought before I knew anything.
Yeah.
I'm going to probably have to cash them out.
Yeah.
I'm probably going to have to pay down the debt.
Yeah.
Because I thought, like a lot of beginners think, and I bought into that messaging. I didn't know what TK was back then, but I thought like one of them.
Yeah.
I thought, this is a cash flow property. What do I care about equity?
Right. Right.
I don't care about equity. This is a cash flow property. It looks like it's cash flow on paper.
Right.
So I went ahead and bought it.
Right.
The problem is, yes, when you reach a critical mass, when you get big enough and you get smart enough, your portfolio overall is strong and stable, and you can sustain a few bad apples in your portfolio
Right.
and wait for the right time to sell, which is kind of where I'm at. I sold
Right.
one SFR this past year, and I'm going to get rid of all of them as time goes. But this inability to exit is a huge problem.
Right. Well,
So you're
yeah.
going to
Oh, go ahead.
use
Sorry.
full leverage to buy this apartment,
Right.
and I'm not clear on what your business plan is to make money with this apartment, aside for the market is going to force the value of this apartment up.
Right. Right.
You're on your own, sister. I don't play that.
Well, Ben, it's way past how long I told you I was going to keep you. I know you studied a lot. Like, how is it that we can start to increase our knowledge of, being able to think more along the lines of the way that you're thinking? And is that part of like what you're doing with your website? And
Well, you know what I do with my website because you enrolled yourself.
right. But
A long
I want to give
time
you an
ago.
opportunity to.
I just asked Ben why I mean, if I don't live on bigger pockets, I'm at my side. And,
Right. Hello?
And Cash Flow Freedom University, the forced appreciation stuff, all of this stuff is in there. It's a course that I have.
Right.
And you can ask Dan, he'll tell you, because he I think probably that's what kickstarted the change in your thinking, Dan,
Right.
if I'm not wrong.
For sure.
But that was one of the things you did is you went through CFFU and kind of started to understand some things.
Right, and one of the reasons why I got it was so I could connect with you, and that in itself has been a worthy educational expense.
Yeah, plus I'm so good looking, so all the times you talk to me on Skype, you're like, oh, this is great.
I'm lucky. All right.
I got one last question.
Oh, we got one more. We got a question here from Ben.
Hi Ben, my name is Ben Hauser. A lot of turnkey operators, they're like guaranteeing renters for like a year or 2 years or 3 years. If a turnkey operator guarantees that, would your opinion of these turnkey properties change at all?
No.
Okay. Okay.
Why should it?
All
Well,
right.
first of all, it's not my opinion of turnkey guys. They're fulfilling a need in the marketplace. That's fine and dandy. If you are buying a mid-range product that is well located and has reasonable expectation of having desirability characteristics to attract the kind of people who are not going to leave you in the middle of the night before paying rent, who are not going to trash your house, in a location where a lot of people own their houses. If you're buying a 1979 brick ranch, if you are, spending $120,000 to do it, if you're buying quality, then okay, so you're giving up a little equity, but all of those economic loss numbers, all of this jazz we've been talking about, that's driven by your tenant base. And you have to ask yourself, who the hell is going to be put in to a $45,000 pig?
Right.
It's pig for a good reason. The marketplace has decided it's not worth any more than that. Look, it costs, if you skimp on everything, it costs $100 a square foot to put up a house. You've got a 1,200 square foot house. That's 120 square feet before you tap and the lot and everything else. This is a pig that's the marketplace is selling it what it is, where it is. It's not worth any more than $45,000. That should tell you who you're going to attract. If the buyers don't think it's worth any more than 45, then why should the renters think it's worth any more than 45? I mean, there's just natural, I think, reasonable characteristics of desirability inherent to us people as human beings. If you have options, would you choose to live there? And if you wouldn't, who would? And what's that profile? And what does that mean to your management of this tenant?
Right.
That was awesome.
So you guarantee, you got to be nuts to guarantee a tenant in a house like that for 3 years. You got to be freaking nuts. Okay, I mean, if you guarantee a tenant in a solid B location, sure. Well, let me tell you, solid B location doesn't happen for $45,000.
Right.
It doesn't happen for $60,000.
Right.
There's no magic to this. I mean, at some point, some logic has to enter the equation.
Right.
Make sense?
Yeah, that was awesome.
Wow.
Thank you.
All right. Well, yeah, Ben, it's been great. Thank you for spending so much time with us today.
My pleasure, guys.
The spreadsheet is awesome. It reminds me of some of the stuff that you that was in the course. So it's cool that you're sort of demonstrating some of the value of being able to understand the numbers and show everyone that stuff. So we definitely appreciate that.
It's my pleasure.
Sorry for keeping you on for so long.
Yeah, dude, you better put a check in mail. Because this is nonsense otherwise, dude. This just terrible. But, you know, I got my shirt on for you, but I can't get up. I don't think you'll enjoy the view.
Oh, man. TMI. TMI. Well, thank you so much, Ben. I don't know what else to say. It's almost 2 in the morning. You're still up. You're still cracking jokes. It's more than we can ask for. And we just really appreciate your spending some time with us.
My pleasure. Good luck in all of your endeavors. Good luck. Just keep in mind, quality is king.
All right.
Thanks, Ben.
Thank you.
Thank you.
Have a good night.